This clip is longer than most. It is packed with information. We will revisit this topic later in the course. We match the costs of our long-lived, non-current assets, such as machinery, buildings, furniture, and automobiles, to revenue through a systematic and formal process called depreciation. Accounting purists call the process amortization instead of depreciation. The definition of depreciation is the systematic and rational process of allocating the original cost of a revenue-producing asset from an unexpired cost, that is asset, on the balance sheet, to an expired cost, that is an expense, on the income statement. Although these assets may provide service for many years, we acquired them for a specific purpose, to contribute towards the generation of revenue streams. Since the revenue streams may occur over several income statement periods, the underlying cost of the revenue-producing asset should be allocated against these streams over the same period on a systematic and rational basis. Systematic and rational is a synonym for remove the discretionary ability of managers of the firm to arbitrarily decide the amount and timing of expense recognition. Usually, when the allocation formula is expressed as a formula, we achieve this effect. Thus, we speak of the depreciation formula. There are several formulas allowed under generally accepted accounting principles, and some are quite esoteric and complicated, but a common and simple method is straight-line depreciation, acquisition cost, divided by the estimated life of the asset. For the windsurfing equipment, this would be $1,000 per month. The $24,000 cost divided by the 24 months estimated for the equipment's useful life. For the leasehold improvements, this would be $500 per month. The $6,000 cost divided by the 12-month lease period. If Josh had signed a lease which gave him the option to renew the lease for, say, a further 2-year period, then he would be justified in amortizing the improvements over 3 years, assuming he believed in his heart that he intended to stay. If Josh wanted to maximize the income reported to the bank for June, would Josh estimate a longer or shorter useful life for the sailboard equipment? While an estimate of a longer life would reduce depreciation expense and result in higher reported net income, Josh should base his estimate of useful life on how long he believes in his heart that the equipment will be used by Windride. While the estimate of useful life depends on judgment, it is not ethical to bend these estimates to mislead users of financial statements. A nuance involving depreciation is that we do not write down the asset directly when we take depreciation, such as we did when we allocated the cost of supplies to expense. The reason for this is that the original cost of capital assets packs a lot of information content. Consider two businesses reporting equipment of $10 million. Company A is reporting virtually new equipment at its original cost, and Company B is reporting 90% depreciated equipment with an original cost of $100 million. Would you not want to know which business has the older, almost fully depreciated equipment? Would you not be interested in the relative size of the two businesses? To provide this information, we use a contra account that is attached to the asset and deducted directly from it to record the depreciation that's been taken on the asset. We think you will agree that this is a much more informative portrayal of the two firms. Showing the gross and net amount of capital assets gives the reader an instant inkling of how worn out the company's assets are and the investment in capital assets required to maintain operating levels. Another final thing we should point out is that land and long-term investments are the notable exceptions to this amortization process. We assume the revenue-generating potential of land is infinite and do not amortize land. With long-term investments in the shares and financial instruments of other businesses, the associated revenue streams comes in a single whoosh when we sell the investments, so periodic amortization is unnecessary.